Look at the rate of growth in Sydney at the moment. CoreLogic RP data reporting nearly a 15% growth rate in Sydney values over the past 12 months. Do you know how much household incomes are growing? Clearly not by that much. In fact, they're hardly moving. So it'd be very hard to see Sydney's housing market continuing to grow at this pace for another 12 months. If you'd asked me the same question last year, I probably would have had the same response. So it's quite surprising to see Sydney running this hard for this long. And large part of it is the fact there's not much stock around. So listing numbers are about 20% lower than a year ago. And a year ago, they're about 20% lower than the previous year. So buyers don't have a lot of stock to choose from. They're making the decisions very quickly. It's taking about 26 days to sell the average property in Sydney. Clearance rates are at record highs at the moment. So I think the market will slow down. There's no doubt about it. And part of that will be due to affordability, partly due to very low rental yields, which will be a disincentive to investment. But also in the background, we have some new macroprudential measures from APRA, which are aimed at slowing down investor demand as well, which I think those three things will conspire to slow conditions around the Sydney market. Clearly, interest rates are a big part of it, and we do expect interest rates will remain low for at least the next 12 months, probably longer than that. What would have to happen in the marketplace to see growth continuing? It has to be more than just interest rates, because we're looking at other capital cities. They're not seeing the same sort of stimulus from the low interest rate environment. So we have to see our labour force would continue to be very strong, which we expect it to be in Sydney. We'd have to see confidence remain very strong. And you probably have to see also investor demand remaining very strong. And I think that's probably where the slowdown will be emanating from, is the fact that investor demand is likely to be slowing down in Sydney due to the low yield environment, due to some intervention from regulatory intervention from APRA, and also just from the fact that investors will be picking the cycle as very mature. Sydney's been growing now for 3 years. Values are up by 40% since the cycle started. So we're seeing affordability constraints hit the market as well. What would be preventing the market from further growth? Well, it's probably those same factors. And if we did see a downturn in economic growth in New South Wales, that would be another factor that would contribute to a slowdown in housing market conditions. That doesn't seem to be on the cards. Population growth is still very strong in the state. It's the strongest economy of any of the states as well, and consumer confidence seems to be relatively buoyant. But of course, household income isn't growing anywhere near the pace that housing market or dwelling values are. Rents aren't growing anywhere near the pace as well. So I think despite very strong economic conditions locally, there are going to be other factors that do conspire to slow this market down.